The truth about LLPAs. So have you heard something along the lines of, like homeowners like me who have good credit are going to be subsidizing those with bad credit with these new changes? Or like those with good credit are now going to be paying more than those with lower credit? If you've heard or read something like this, well, I'm here to set the record straight with the truth about LLPAs. Now, I'm not here to debate whether these changes are good and bad. You can do that yourselves in the comments. I'm not going to participate in that. But what I am going to do is break this down for you. So, TLDR. Yes, there are changes, and as of today, May 1st, they take effect. These changes are way more complex than really anyone is covering right now, the media and all that. And even I'm going to simplify things, or else we'll be here for like 45 minutes. So I'm not going to get into that. Note that these changes don't represent pure decreases for high-risk borrowers or pure increases for low-risk borrowers. While it's true that many with good credit will get reduced benefits, some will actually see no change at all, and there may be some of you that actually get a slight increase in your benefits to having a good credit score. Alternatively, most of those with the below average credit will be penalized less than they previously were. So some will still see no change, and some might even get a slight increase in their penalties. So the bottom line is that your higher credit, you'll still be paying lower rates than those with lower credit. The gap is just smaller now. It was very extreme, and now it's much more concentrated. So what are LLPAs? Without getting too into the weeds, it's a loan level price adjustment. These are fees to obtain loans that meet certain conditions so that they can then be sold off to like Fannie Mae or Freddie Mac, and those are two government created organizations, and I'll get into that in a little bit. But the key here is that these only affect conventional loans, one that's greater than 15 years. There's some other requirements too. But the key thing here is that these LLPAs do not affect VA loans, FHA loans, or USDA loans. So also it's good here to point out that, you get penalized for a bunch of things, with these LLPAs. I mean, if it's a mobile home, it's a condo, if it's a second home purchase, high balance loan, cash out refi, they just jumped up the rates on those, the fees on those. And if you're buying multi-unit properties up to 4, right? So a duplex, triplex, quadplex. And then another thing to note is that these fees can be paid at closing, or it can be paid for with a slightly higher interest rate on your loan. So you're paying it over time. So why did these LLPAs change? Well, just think of it this way. It's like they engage in risk-based pricing. Think like auto insurance and things like that, right? Where your insurance will depend on the type of car you have, how old it is, your driving history, all those kinds of factors, right? Similar here. There's a lot of factors that roll into this. And what they found is that these LLPAs have been very outdated, and they weren't reflecting the actual historical risk for these levels. So, and that's directly from the FHFA, which I'll get into in a little bit too. So if you are in a position where you happen to fall into one of the categories where you would be paying more than you would have before, just expect that you'll pay a couple more grand at closing, or you would actually have a slightly higher payment. So let's say, for example, you pay if you had a $2,000 payment, you add about $40 to your mortgage, basically, and that's what it would be. So here are a few options that you can consider to avoid these fees or minimize the impact of these fees, right? First, you can adjust your loan to value by putting more or less down to get out of those high fee categories in order to lower your fees. You can consider non-conforming loans. Some of those, for example, like jumbo loans are not covered by Fannie Mae, Freddie Mac, or look at doing like a 15-year term or less if you can swing it. And then also consider the other types of loans, right? You have the FHA loan, which is a really good product. You have USDA and VA if you qualify for it. So you may be asking that why is the government in the mortgage business to begin with? That's a good question. Well, Congress created Fannie Mae and Freddie Mac to make it easier for the average person or family to be able to buy a home. It's interesting to note here that about 90% of all home loans here in the United States are government backed. You're talking conventional, FHA, USDA, VA, right? Most people would not be able to get a home loan without these products. And so what would happen? It would be only the upper class that would be able to afford to be able to buy homes and then rent them out to you. So I mentioned the FHFA before. That stands for the Federal Housing Finance Agency. And they oversee both Fannie Mae and Freddie Mac and they're the ones that had made revisions to these LLPAs. And despite what some may have been telling you, presidents have no direct authority on any of this. They have no say in how these fees are adjusted. The president can appoint the FHFA director, but then that FHA director has pretty much autonomy to run it as they see fit. One thing to note about this is that both Fannie Mae and Freddie Mac have been in conservatorship since 2008, which basically means that the taxpayers are on the hook, right? So one of the main goals of FHFA is to get Fannie Mae and Freddie Mac out of conservatorship and reduce the financial exposure to us, the taxpayers. And that's it. I know I hit you with a lot of stuff all at once, but I do have links in the comments below that go more into detail if you're interested. And that's it for now. Take care.